Hi, this is Brandon Bischoff. I'm Vice President of Portfolio Strategy here at Canterbury Investment Management. And today, Tom Harden and I are going to be discussing 2020 in review. And so we're going to talk about the markets that occurred last year. We're also going to talk about the portfolio thermostat and its adaptive process. But mainly, what did it do to navigate the difficult market we saw last year? So with that being said, Tom, are you ready to get started?
Sure, Brandon, let's go.
So I think the year 2020, particularly in the markets, is a really good example of how you can show, how an adaptive portfolio changes. So let's talk about the markets. First of all, there was a lot of good and bad and just flat out ugly in the markets during 2020. So let's start with that. I'll give you some of the good. The good is that, at the time this video is released, 2020 is over. We're officially in 2021, and that's good news. So why don't you give us some of the other news?
The bad and the ugly?
Yeah.
Okay, well, I think the ugliness really started about mid-February when most major market indexes dropped 30 to 40%, and that happened over about 21 days. That is called a trading anomaly. And that was really rare. I mean, to have a drop of that magnitude that quickly is something that rarely happens. But we also know that when you have a trading anomaly like that, you can pretty much expect a 40 to 50% rebound to get half of that back over a relatively short period of time. And that's exactly what happened.
And so when you say trading anomaly, what's the difference between a trading anomaly and like a bear market? Because I remember watching, the news media in here, and I think Liz Clayman was on TV, and she was saying something along the lines of, okay, if the market drops another 50 basis points, we're officially in a bear market. But you're calling this a trading anomaly. So compare and contrast, what's the difference between those two things?
Yeah, well, the term bull and bear market's been around for a long time, and someone at some point decided that a bear market was a 20% decline. Why not 19? Why not 21? But really, a bear market is a period of higher volatility that lasts for a period of time, usually 2 years or even more. It's a period when you see a low and then you see a rebound, but it doesn't get back to the previous high, a lower low, lower high, lower low. People get very depressed, and then finally it begins to turn around, and it takes even longer typically to get back to break even. So you could look at the bear market that really kind of extended from 2000 through, in my opinion, 2013. That's how long it took for the market to get back above where it was in 2000. You have 13 years of not making money with 2 periods where you had a 50% plus decline.
So I think it's good news that this was a trading anomaly.
And yeah, trading anomaly is a very short period.
Right, and so the market's already back above the levels it was back in January, February. Moving on, we need to talk about, adaptive portfolio management in the face of, this trading anomaly, in the face of this high volatility, and how it adapted its holdings and how it maintained what you're calling portfolio efficiency through all these different events.
Sure. So since the markets are dynamic, the rules that you follow also have to be not only defined but dynamic. And coming into this February period, this drop was almost like a tsunami. It just kind of, everything was calm, volatility was low, and then all of a sudden it just hit, and it hit hard in a very short period of time. So the allocations we had coming into February was set for that low volatile environment. So then when you had this sharp decline, then what happens is that we know that an anomaly is going to get this rebound, so we have to pretty much hold those positions.
Okay.
I mean, one thing that you wouldn't want to do is to wait till the market dropped 30 or 40% and then say, now we're going to stabilize it. We're going to put in inverse funds. We're going to stabilize the portfolio.
To make the portfolio efficient.
Yeah, and then get that 50% rebound. You'd never be able to make up for that. So the strategy for an adaptive portfolio is when you have an anomaly, wait for that kickback, that 40 to 50% kickback. And again, no one knows how far that decline could have happened, but we know that the kickback rally will be almost as fast is what the decline was, and then you stabilize it. And from the time that we stabilized it in mid to late March till the end of the year, our volatility was extremely low. As a matter of fact, the biggest decline that we experienced in the portfolio after it was stabilized was 4.5%, which is nothing. I mean, if you're just watching our portfolio, you wouldn't know that anything rare or strange was going on in the world. So when you look at the course of the year, we did very well. And again, I don't know what we could have done to do any better to be able to maintain our objective, which was keeping the portfolio stable.
So talk about this concept of, we talk about in weekly updates, the outlier days. What is an outlier day? And since being stabilized, how many outlier days has the portfolio experienced? Maybe how many have the markets experienced?
Yeah, outlier days is something that you just don't hear about. And we define an outlier day would be any day where the market or portfolio might move beyond, say, 1.5%.
Up or down?
Up or down, either way. So in other words, when you get these 6, 7, 8% days, those are just, they're outliers. They're things that really shouldn't happen. So an efficient portfolio should be diversified in a way to where you limit those outlier days to being very few in a volatile market, if any at all. Mm-hmm. So I can say that from the time we stabilized the portfolio through now, our portfolios had 4 days that were somewhere between 1.5% and 2.5%.
Oh, wow.
And no days that were more than a little over 2%. To kind of put that in perspective, the S&P 500 had something like
40 or 50 days.
40 or 50 days. Even the value index, which is considered to be conservative, has had over 50 days. So again, that shows that the markets themselves were not really very efficient. Mm-hmm. But for whatever reason, the markets never really had that big of a correction. I think it had 2 or 3 little pullbacks of, that 10, 12% area. But we never had a pullback. So our portfolio never really had that opportunity to take advantage of the decline while we're stable, the markets go down, and then take some of the inverse off and benefit from the market's fluctuations.
So given all these market events that we've seen over the last year, how are we able to maintain efficient diversification? Meaning, how are we able to, really adapt the holdings to keep them moving differently from one another in order to maintain stability and low volatility in the midst of this difficult market environment?
Brandon, it's a systems thing. Trying to stabilize a portfolio to have very low volatility in an environment like we saw through 2020 is a very difficult thing. And part of being able to do that is not about necessarily owning all of the best ETFs at a given point in time. So in other words, we have to own some inverse securities because the market's going to fluctuate both directions. And, on one hand, we had some inverse securities that might have dropped 15, 16, 17%, but we also had long positions that were maybe up 30, 35%. So what we want to do is to be inverse some of the worst groups and then be long or own some of the very best groups. And when you put the two together, we have that high benefit of diversification because things are moving different from each other. You put those together and it stabilizes the portfolio. So again, that takes a system to be able to get that combination right. And I can tell you from the end of March, when we stabilized through the rest of the year, the biggest decline that we experienced in the portfolio was a little less than 4.5%.
So Tom, I've been watching, Fox Business and CNBC, and it sort of seems that at the end of every calendar year, they sort of handpick after the fact some of these managers to bring on and talk about, their performance. And they all kind of come on and say what an outstanding year it was for them. How do you respond to that?
What's my response? My response is that anyone who had a really good year last year played a game of Russian roulette, and they won. I mean, There's no question that last year was a very risky environment. Anyone who did well last year threw caution to the wind. They had a lot of money in equities, specifically in technology. As a matter of fact, the technology stocks right now make up about 43% of the S&P 500. And from the time that we stabilized the portfolio in mid-April, the technology sector had gone up 40% through the end of the year. Now, keep in mind that the S&P 500 is about 43% technology, and it went up about 15% during that same time, meaning that the other 9 sectors really didn't do very much. Now, of course, we had technology, but we can't have 40% plus, so we were pretty much flat on the year, and we did that with extremely low volatility. The markets never really corrected, so basically they got lucky. The problem is that the game continues, and it's only a matter of time till the market corrects meaningfully, and what made them successful in the past will make them unsuccessful in the future. Making money only matters if you can keep it. And if you have a strategy that does not have an element of risk management, then it's only a matter of time till you're going to step on the proverbial landmine and do serious damage to your investment program.
We see a number of examples, whether it's 2000 or it's 2008, where investors lose a substantial amount of money in their portfolio. And really they ultimately lose confidence in themselves, or they lose confidence in their advisor and their advisor's ability to pick investments for them. Why is it that investors are so worried? And why is it that it's so hard to make money in markets?
Good question. The objective, I think, of most investors is to become financially independent and to be able to live from their portfolio, or at least have a substantial amount of their income ultimately come from their portfolios. And I think you can take people who've saved for a long time and have invested for the long run, and many of those people have not been financially independent, or they haven't been able to maintain it for an extended period. And I think when we go back and see why that was the case, it comes back to the idea that markets have these bearish periods where there's substantial declines and investors can't really recover from it. And that's just kind of the price you pay for having something that's liquid and driven by supply and demand. So if you have a strategic portfolio that never changes its allocations, it's only a matter of time until you have one of those big declines that ruins your ability to remain financially independent. And if you look at it from that perspective, when you look at the risk versus reward of being in markets for a long run, it's not really that good. The idea is that every investment has advantages and disadvantages. If you owned a business, you manage the business, and you manage every aspect of the business, and you want that business to be profitable. Owning a stock is not like owning a business. Okay, owning a stock or a security is going to fluctuate in price regardless of what the earnings do for the company, and they will have bear markets. So the objective of owning a portfolio of financial securities is to be able to maintain and create an efficient portfolio, one that has the proper diversification that can limit the declines and then still participate in the upside. That will then allow you to get that compounding effect where a double, you get a double and it doubles again and again, and it continues to grow on a geometric basis. And that's something that most portfolio managers have been unable to do. They really have no answer for these bear markets.
So given that, what state is the market really in right now?
Well, it's in a very interesting state because, again, anomalies are defined as something that rarely happens. To see that kind of decline was rare, but to also see it not only rebound, but to continue up without any meaningful correction is even more rare. And we have to take a look at, what caused that? What allowed the market to get back to break even so fast without any major decline? And in this particular case, it was all about technology-related stocks. a lot of these other sectors in the market, basic materials, energy, utilities, there's 10 sectors that make up the market. They had further corrections. A lot of those didn't come back very quickly. But technology has been so strong that it makes up a large component of the S&P 500. So what's happened is technology has taken off to the point where it's actually created a bubble. And that bubble is not burst yet. And if it weren't for technology, you wouldn't have had that good of a year last year. But the other side of that is that markets don't understand the calendar. They don't know that 2020 ended in December the 31st. This continues, and that idea of that rubber band is stretched. That technology rubber band, the market itself has been stretched, and we know that there's been a lot of bad news, and we know that over the last 10 years, technology is up like 900%. That eventually we're going to see that burst of the bubble called technology, and that will have a real negative effect on the indexes.
Great, Tom. Now I want to look ahead, right? So given everything that just happened this year, where do we see ourselves heading into 2021? The market is at or near a new all-time high, but what's it going to look like going forward? Can you make a prediction on that?
Well, it's very difficult to make predictions, particularly when you're talking about the future. But what I can tell you is that this is really one of the major downsides of benchmarking, because markets, like you say, they do kind of run in trends. You'll have this 8-10 year period when there's no real major correction, and everyone thinks, well, now I need to be in the S&P 500. If I would have done that, I would have done much better, as opposed to being diversified. And then about the time everyone agrees, then the markets will do the opposite, and they'll go down. So we've now had a period from 2009 for 11 years where there's been no meaningful correction, and technology is now 42 to 43% of the market, which is the biggest that any sector has ever made up of the S&P 500. I would have to say that the future is going to look more volatile, and assuming that we're going to have bear markets, which we've always had, after 10 or 11 years, we are due for an extended period of volatility in a difficult market environment.
And to clarify, I don't think what you're not saying is you don't know when a bear market's going to come.
No, we don't.
Right. But you do know that bear markets have certain characteristics.
Yes.
You mentioned earlier it's a series of, lower lows and lower highs. And do you think that maybe this trading anomaly we just saw could be like a foreshock to a potential bear market?
Absolutely. One thing that we've noticed is that, again, bull markets have low volatility. When you get somewhere near the end, you start seeing these little anomalies. So it's, again, like you said, it's similar to an earthquake. You get a few foreshocks before you get the bear market. I mean, you have these declines, but they still go back and put in a higher high. Investors get complacent, and then eventually you begin to see a decline, a rebound, doesn't get back to the old high, and then we begin to see the high pessimism eventually as we bottom out in a bear market.
Well, great answer, Tom. Our team here at Canterbury Investment Management would like to thank you for taking the time to listen to this conversation we had, and we look forward to working with you in 2021, and we wish you and your families well.
Thank you.